All right, let's dive into this question. Super important question. What size of business can you actually afford? Here's why it's so important. Buying a business can change your life or wreck it. The difference usually comes down to one thing: buying the right size of business. If you buy too small, you're basically buying yourself a stressful job that pays less than what you could earn working for someone else. If you buy too big, you risk getting crushed by debt, losing your savings, putting your family under undue stress that you just don't necessarily need. So, buying the right size of business is vital. The question really is how to determine what you can actually afford. So that's what today's episode is all about. I'm going to show you how to calculate your ideal price range, the number that keeps you safe, gets the bank approval, and still pays you a livable salary. By the end of the episode, you'll have a framework that you could use to save years of wasted time and possibly hundreds of thousands of dollars if you bought the wrong business. So let's dive into it. Why the size of the business is even important. So, question to ask yourself: why is the size of the business even important? Shouldn't I just buy whatever I can find, whatever I can afford, whatever the bank tells me I can afford? No, don't do that. Size is everything when it comes to buying a business. Think of it like Goldilocks: too small, it doesn't feed you; too big, and it smothers you. You want to find something that's just right. It supports your lifestyle without breaking you. That's really key. So here's what happens when you get it wrong. If you buy too small, you're basically working 60 hours a week to make $60,000. I'm just making up some figures here to illustrate the point that you'd make more working as an employee for someone else with way less stress and probably less hours. However, if you buy too big and you go to the bank and they laugh you out, decline the application, or worse, you somehow close on the transaction and then you can't cover the debt payments. I've seen that happen too often, and it just crushes the whole family finances because let's be honest, if you're using the SBA to finance a transaction, you're putting your family finances at risk. They are taking a collateral position on your real estate, on your personal home. So we want to get this right. Buying the wrong size is like running a marathon in a shoe that doesn't fit. It doesn't matter how much grit you have, you're going to get blisters and quit, and it's not going to be a good experience. I can tell you from personal experience, not buying the wrong shoe, but having run a race that was way too long that I wasn't properly trained for, and my knee did not like it. So here's the question I ask myself. I ask clients all the time: why not just stretch and go for the biggest business you can possibly get? Bigger business means more money, more profit, right? Yes and no. Here's the problem: because banks don't fund dreams, they fund math. So we want to really look through the math on this. If the business doesn't show enough cash flow to pay you a livable salary and cover the loan payments with cushion, you're dead on arrival. Or if you're not dead on arrival and you somehow get through the transaction, you're in a really tight position if things don't go well 6 months later, 12 months later. I see buyers burn out in that 6 to 12 month later after chasing the deal that they think they would qualify for, only to find out they've been shopping for a mansion when their credit score really or their income really just doesn't justify that size of a purchase. So you're not even in the right ball game. Or if you are, you're pushing it too far where you're just putting the family finances at risk that you don't need to. So the real question becomes, how do you know your number, the exact size of business that you can afford? This is where I like to use my life formula, LIFE. So this is where this helps you, so it's memorable, it's practical because it's an acronym. So life stands for first L, livable salary. Does this business pay you enough to live on after paying the debt? I in life is income cushion. Is there extra cash flow left over after the loan payments? Banks require, depending on the bank, a DSCR of at least 1.25. That's way too low for my recommendation. Look for something at a 1.4 or above DSCR. That gives you some cushion. That gives you the income cushion. It takes care of the I for the income cushion. Next is F in the LIFE acronym, and that's a financing fit. Does the deal size match what the bank actually will lend on for you? And the bank will help you determine F for the financing fit. And finally, E in our LIFE acronym is effort reality. How much time and how much work is it really going to take? Because a business that eats up your life isn't freedom. That's just a prison sentence. And you happen to be getting paid to be in a prison sentence. We want to avoid buying a business that's too big or too small, but we also want to make sure you avoid buying the wrong lifestyle business. So, how do you actually run your You use a simple calculator that plugs in the numbers. You type in the SDE, what's known as seller's discretionary earnings, the purchase price, the loan terms, and it spits out whether your deal covers your salary, covers your debt, and it passes the DSCR. If it doesn't, then you have two options. Either pass and move on, move to the next deal. There are plenty of deals out there, or you need to start massaging the numbers. Maybe the purchase price comes down. You can't change, and I wouldn't recommend changing the SDE figure. That is what it is. And I wouldn't recommend changing your livable wage, what you need to support the family. So the only thing you can really control there is the purchase price. As the purchase price comes down, the DSCR is going to go up. So play around with the purchase price to make sure if you do find a business that's ideal for you from a lifestyle standpoint, a location standpoint, but the numbers don't work, then bring down the purchase price to make the numbers work so that it covers your livable wage. It meets the life formula, covers your livable wage, covers the debt that you need to pay, and it takes care of your family and leaves you enough cushion to make sure you're not getting into a business that you shouldn't be purchasing. Let me give you just a quick story here. I had a buyer who once bought a $150,000 coffee shop. On paper, it looked like a cute little business. In reality, the owner was working 70 hours a week and taking home $35,000. She could have made more, honestly, working at Starbucks with health benefits. She bought a business that was too small and too many hours. Yeah, you have the freedom of working for yourself, but do you really want to work for yourself and get paid less than what you could just working for someone else? That's a personal decision you'll have to make. Most of the time, I would say no. Let me give you an opposite example. Another buyer chased a $5 million business because that's the SBA limit. He made good money in his career, but not enough for a down payment and reserves in a bank. He wasted 9 months chasing a deal that the bank was never going to fund because he just couldn't quite get all the pieces together. He was chasing a deal too big. He probably should have been more in about the $3.5 million range. If he would have bought a business in that price range, he probably would have been able to close a deal and probably would have been able to find a really good business in that size. So I'll give you now a just right, a Goldilocks business. Someone that bought in the sweet spot. I had a buyer pick up a $1.2 million HVAC company, had about $350,000 in SDE. He took home a $150,000 salary. After debt, he had a DSCR of 1.5 and he kept $100,000 in reserves. This met the acronym, the LIFE acronym formula. It checked all the boxes. And to this day, I haven't talked to him for a number of months, but a couple of years after closing, business was going well. It was providing for his family, it was servicing the debt, he was continuing to grow the business, and he had the right life formula, and it worked well. It was the perfect buy. So, what exactly are banks looking at when they decide to give you a yes or no decision? Banks primarily care about three things: debt service coverage ratio, DSCR, that's cash flow divided by the loan payments, less your livable wage. If it's under, they just will give you a decline. They'll shut the door. It's not a good fit. They're also, and let me go back. I said earlier a 1.4. That's really what I'm looking for. 1.4 DSCR or above. Technically, could you get a deal done at 1.3? Yes, but you're cutting it close. So be careful if you go under 1.4, but definitely don't go under 1.3. The second thing the banks care about, post closing liquidity. They want to see if you have enough cash left in the bank after the down payment. Usually 10% is what they're looking for on a down payment. And then you need to have some cash left over. They don't want to take your last dime to put this all of your savings, your family finances, your life savings as a down payment, and then you've got no post closing liquidity. One of the biggest mistakes that I see buyers make is they put too much of their savings as a down payment trying to stretch to buy a business that's too big. I usually recommend leave half of your savings for post-closing liquidity and half of it for the DSCR. That's the great thing about on this page, you'll see a calculator that's completely free that will allow you to plug in all of your numbers and it will calculate your livable wage. It'll calculate taking half of your available down payment or your savings for the down payment. And then finally, the third thing banks care about, we've talked about it already, is your livable wage. They don't want you starving because hungry buyers default. That's the bottom line. That's all they really care about is making sure that you don't default. And the way to ensure that you don't default is to factor in your livable wage. Now, a lot of people may or may not have a budget. So you need to get a really good grasp on what does your family need from a just a operating standpoint to keep the family operating. In one sense, that's a business in and of itself, and you should be tracking that. You should have a budget so you know if you need, I'm just making something up, $115,000 to support a wife. Maybe the wife works, and then you can lower that, how much you need. Maybe the spouse doesn't work, and you have to support the family, and you've got whatever it is, two, three kids. You need to factor in how much do you need. You can't guess at that, and you can't just take some general averages. You need to know what your family needs specifically, what your livable wage is, and factor that in when you are calculating the ideal purchase price. So don't wing it. You need the math dialed in here. This really matters here. Okay, so how do I stop wasting time on the wrong deals? Use the life formula as a filter before you even sign an NDA and start going down the road talking to business brokers or potential sellers. Ask yourself, is the business in my affordable range? That's why you should use the calculator on this page so you can only look at businesses that are in that general range that it spits out and recommends for you. Ask yourself, does it realistically pay me enough from a livable wage after the debt? If the answer is no, don't even bother looking at that business unless you have a partner that has more capital and more down payment. It's just a waste of time. And you don't want to start looking at businesses that are going to be a disaster waiting to happen down the road. That's how you save hundreds of hours is just look at the right size of business to begin with. So, a couple of takeaways here. I'll recap the mental model so you can write it down. The life formula, LIFE, livable salary, income cushion, financing fit, and the effort reality. How much effort is going to take to run the business and replace the owner? Memorize that, write it down, tape it to your desk until you can find the right business because it needs to fit in that mental model to make sure that you're buying a business that's going to be a blessing to your family, to your future, not a curse down the road. Action steps for listeners at this point, run your number. Use the calculator on this page. It's totally free. Find your ideal price range. Number two, commit to staying in your lane. Stay inside that range. Don't chase shiny deals because they look like they are a really good transaction or they look like the multiple's really low or it looks really profitable. If it's not in your range, don't even bother with it. Don't get distracted by it. Filter fast. So before you spend months on a deal, check to make sure it passes the life test. So here's the bottom line. Most buyers fail, not because they can't find the right business, but because they chase the wrong size. Too small feels like a job, too big feels like you're drowning. The right size gives you the income, the security, and the freedom. And the way you know that is to focus on the life formula: livable salary, income cushion, financing fit, and effort reality. Run the math, stick to your lane, and you'll save yourself years of pain and wasted money. So, if this episode hits home, share it with someone who is thinking about buying a business, maybe a spouse, maybe a partner. Make sure that they understand your framework that you're going to be using so that they can help you stick to it. Because we don't want to waste a year chasing the deal that never closes. And if you haven't already, go run your number because the smartest buyers know their life formula before they even make an offer. So use the calculator, enjoy, and we'll see you in the next one.